Wall Street history, there are quarters that define an era. Morgan Stanley just had one of them. ROTC of 27%, record revenues across every single segment simultaneously, and a wealth management business that just hit the profitability milestone management has been promising for 3 years, ahead of schedule.
Q1 2026 net revenues came in at $20.6 billion, up 16% year over year. EPS was $3.43 against a street estimate of $3.06. That's a 12% beat, not rounding error territory. The stock moved over 5% on the day.
We are covering Morgan Stanley, ticker MS, Q1 2026 earnings reported April 15th. I'm Hudson Thomas.
And I'm Lana Chen. This is Charged Alpha, the S&P 500 stock encyclopedia. Let's break down one of the best quarters any major bank has had in recent memory.
Morgan Stanley was founded in 1935 when Henry Morgan and Harold Stanley left J.P. Morgan to start their own firm. They wanted to do underwriting, which the Glass-Steagall Act had just separated from commercial banking. Within its first year, it underwrote $38 million in bonds for cities and corporations. Today, that same firm manages $9 trillion in client assets.
The firm operates through 3 segments. Institutional securities is the classic Wall Street business. Investment banking, equities trading, fixed income trading, and prime brokerage for hedge funds and institutions. This is where the bank makes deals happen and facilitates markets. Wealth management is the business of serving individual clients, financial advisors, the E-Trade platform, retirement accounts, lending. And investment management runs money for institutions, endowments, sovereign wealth funds, pension plans, with $1.9 trillion under management.
The genius of the business model is how these 3 talk to each other. A CEO relationship from investment banking becomes a wealth management referral. A hedge fund prime brokerage client also needs private wealth services. CEO Ted Pick calls it one firm, the idea that the 3 businesses are stronger together than apart. Revenue of roughly $79 billion, trailing 12 months. Market cap around $302 billion. 81,000 employees globally, headquartered at 1585 Broadway in New York City.
The reason this story is compelling right now is what just happened in Q1. All 3 segments reported record revenues in the same quarter. That has not happened often. Institutional securities hit record highs. Wealth management hit a pre-tax margin milestone the firm had been targeting for years, and the client asset base crossed $9 trillion total, a compounding machine that generates fee income regardless of market direction.
The moat is distribution. $9 trillion in client assets is infrastructure that took decades to assemble. You cannot build that overnight. Add a top-ranked institutional franchise in equities and investment banking, and the one-firm cross-sell flywheel, and you have a business that is genuinely difficult to replicate from scratch. Ted Pick became CEO of Morgan Stanley in January 2024, making him just about 18 months into the job. He spent 32 years at the firm before ascending to the top role, building and running the institutional securities division, the trading and banking engine. He is the first CEO to have come up through the market side rather than the wealth management side.
Pick's reputation on the street is as a capital markets expert who understands both sides of the institutional business, the client relationships that drive IB fees, and the risk management that underlies trading. His one-firm philosophy is already showing tangible results in Q1, with wealth management flows benefiting from institutional client introductions.
His Q1 commentary was notably confident. He said all 3 of Morgan Stanley's segment total addressable markets are growing at approximately 2 times GDP, and that the firm is capturing 10 to 15% share depending on the business. He called the private credit market an adolescent phase with decades of growth ahead. That's a CEO who sees a long runway, not a peak.
The context matters here. His predecessor, James Gorman, ran Morgan Stanley for 14 years and fundamentally transformed it from a pure trading house into a wealth management powerhouse. Pick is the beneficiary of that transformation and the executor of its next chapter. The Q1 results are the clearest evidence yet that the model is working. Let's get into the financials. Starting with valuation, Morgan Stanley trades at approximately 16.4 times trailing earnings, price to book at 2.68 times, price to sales at 2.5 times, market cap $302 billion, with the stock at $190.08.
How does that multiple look versus the firm's own history?
The current PE of 16 times is actually at the lower end of Morgan Stanley's historical range during strong earnings periods, because the earnings themselves have grown so dramatically. The forward PE is closer to 15 times, which is quite reasonable for a firm delivering 27% ROTC.
Walk me through Q1.
Q1 2026 net revenues were $20.6 billion against a street estimate of $19.7 billion. That's an $860 million beat. EPS of $3.43 versus $3.06 estimated, a 12% beat. These are standout numbers.
What drove them?
3 separate engines firing simultaneously. Institutional securities delivered $10.7 billion in revenue, a record, with equities trading up 25% year-over-year to $5.1 billion, fixed income up 29% to $3.4 billion, and investment banking fees up 36% to $2.1 billion, with advisory fees specifically up 74%. Wealth management delivered $8.5 billion, also a record, with net new assets of $118 billion in a single quarter and a pre-tax margin of 30.4%. Investment management contributed $1.5 billion with AUM of $1.9 trillion.
$118 billion in a single quarter.
That's not a misprint. That's more than most of Morgan Stanley's competitors attract in an entire year. It signals that clients are actively moving assets to the platform, not just letting existing assets compound.
What about the margin picture?
Gross margin on a trailing basis is approximately 58%, operating margin around 19.5%, net margin 15%. But those TTM figures are lagged. The Q1 ROTCE of 27% is the forward-looking metric that matters here. For context, Goldman Sachs delivered about 19% ROTC in Q1, and JP Morgan was at 23%. Morgan Stanley at 27% led the peer group.
Balance sheet?
Total assets, approximately $1.6 trillion. CET1 capital ratio of 15.1%, well above the regulatory minimum and providing 300 basis points of excess capital. Total equity around $112 billion. The firm accreted $15 billion in capital over the last 9 quarters through retained earnings. Tangible book value per share at $51.58, up nearly 12% year-over-year.
And shareholder returns?
Q1 buybacks of $1.75 billion, 10 million shares at an average price of $169 per share. A new $20 billion multi-year repurchase authorization was approved by the board, plus the quarterly dividend of $1 per share, implying $4 annualized, yielding just over 2%. Overall, Morgan Stanley's financial health is strong. ROTC of 27%, record segment revenues, a 15% CET1 ratio, and a new $20 billion capital return commitment. This is a fortress balance sheet delivering elite-tier returns.
19 analysts cover Morgan Stanley. The consensus is moderate buy, 8 buy ratings, 11 holds, and 0 sells. Average price target of $189.94, right in line with where the stock is trading now after the earnings pop.
Before earnings, UBS upgraded Morgan Stanley from neutral to buy with a price target of $196. They were ahead of the Q1 beat. Evercore ISI maintained its outperform rating but cut its target from $215 to $190 in early April, citing macro uncertainty around capital markets activity. JP Morgan maintained neutral and raised its target from $173 to $179.
How did the street react to the Q1 print on April 15th?
Very positively. The stock closed up over 5% on the day, one of the strongest post-earnings moves Morgan Stanley has had in several years. The combination of the institutional securities record, the wealth management margin milestone, and the NNA figure of $118 billion exceeded what most analysts had modeled. Post-earnings notes from Barclays, RBC, and Oppenheimer all reiterated outperform or overweight ratings.
What was the main pushback?
The hold-heavy analyst camp centers on the cyclicality concern. 11 of 19 analysts are at hold, which reflects skepticism that Q1-level institutional revenues are repeatable. If equities trading and IB fees normalize toward more typical levels in Q2, the consensus fear is that the aggregate EPS run rate implied by Q1 will prove misleading. The bulls counter that wealth management's fee income provides a durable floor.
Let me lay out the bull case. The core of it is the wealth management flywheel. $9 trillion in client assets, $118 billion in net new assets in a single quarter, and a pre-tax margin of 30.4%, the 30% target the firm has been promising for 3 years, delivered ahead of schedule. That combination means wealth management is now a compounding engine, generating predictable fee income that does not depend on capital markets activity or interest rate levels.
Add the investment banking revival. Advisory fees up 74% in Q1 reflects a reopen of the M&A cycle that has been largely frozen since 2022. Morgan Stanley is consistently top 3 globally in advisory. When deal flow returns, they capture outsized share. The backlog building is a multi-quarter tailwind.
And then there's the capital return story. A new $20 billion buyback authorization at a firm generating $5+ billion in quarterly net income. At current prices, that buyback retires meaningful share count over 2 to 3 years, compounding EPS growth even without top-line expansion.
Now the bear case. 11 of 19 analysts are at hold, and the reason is straightforward. Capital markets businesses are among the most cyclical on the planet. Equities trading at $5 billion and IB fees at $2 billion were record outputs. They will not be records every quarter. In a risk-off environment, falling equity markets, frozen deal pipelines, reduced hedge fund leverage, both can drop 20 to 30% sequentially without any change in the underlying business quality.
What about the wealth management sensitivity?
Fee-based revenue is tied to asset values. If the S&P 500 drops 20%, the wealth management fee revenue base shrinks by a similar magnitude automatically, without any client churning or advisor departures. The $9 trillion asset base is a strength when markets rise and an amplifier when they fall. At 30% margins, wealth management has less operational leverage to absorb a revenue decline than a more cost-variable business.
And the CEO transition risk is real.
Ted Pick is 18 months in. James Gorman transformed this firm over 14 years. Integration between institutional and wealth management, the cross-sell that makes the one-firm thesis work, requires sustained organizational commitment. Any disruption in key talent or strategic alignment during this transition is a meaningful execution risk that the model has not been stress-tested on at Pick's specific leadership.
The most natural comparison for Morgan Stanley is Goldman Sachs. Goldman trades at about 2.6 times book value, very close to Morgan Stanley's 2.7. Goldman delivered ROTCE of roughly 20% in Q1 2026. Impressive, but below Morgan Stanley's 27%. Goldman is more heavily skewed toward institutional securities and less anchored in wealth management, making it more cyclically exposed to capital market swings.
JP Morgan is the other obvious comp, ROTC around 23% and a PB of 2.4 times book. JPM is more diversified across consumer banking, corporate lending, and capital markets, which gives it a different risk profile. Morgan Stanley's premium PB to JPM reflects its higher current ROTCE and the quality perception around the wealth management model.
Bank of America is the value end of the comparison at 1.3 times book. Lower ROTCE, more NII sensitive, less capital markets torque. The back discount versus Morgan Stanley reflects the earnings mix difference, more rate sensitive, less fee driven.
The takeaway is that Morgan Stanley at 2.7 times book and 27% ROTCE looks reasonable against Goldman and JPM. If ROTCE stays structurally above 20%, the current PB premium is justified by superior capital efficiency. If ROTCE reverts to 15 or 16%, the premium compresses.
The options market was sending an unusual signal heading into Q1 earnings. Put-call ratio of 1.6, that means 1.5 puts were bought for every call. That's a notably defensive posture for a firm that had been reporting improving results.
fee percentile at 30 was moderate, not pricing an extreme event, but the put-heavy flow said institutional players were hedging against a downside surprise. The stock's 5% plus post-earnings rally was a significant squeeze for those put holders. Call OI had been building at the $195 and $200 strikes before earnings, pointing to some bullish positioning above current levels.
A fee crush post-earnings was the expected outcome, given that moderate IV level, implied volatility collapses after the uncertainty is resolved. The put-call imbalance correction added fuel to the post-earnings rally.
Insider activity has been active in volume, but the context matters. CEO Ted Pick sold 100,000 shares on April 16th for approximately $16.4 million. President Andrew Saperstein sold 51,668 shares at approximately $189 for $9.7 million. Total of about $25.2 million in shares sold by insiders in the past 6 months, 0 purchases.
That sounds like a lot of selling.
All of it through pre-scheduled 10b5-1 trading plans. These are set up well in advance, typically for tax planning or portfolio diversification, not as a signal about the stock's direction. The CEO selling at $164 a share and the stock now at $190 actually suggests the plans were initiated when the stock was lower. The 0 open market purchases is the more relevant read. At current prices, near the 52-week high, management is not buying additional exposure beyond their compensation grants. 3 things to watch closely for Morgan Stanley from here. First, whether capital markets revenues sustain in Q2. The equities trading record and the 74% jump in advisory fees reflect a specific market environment. If deal activity slows and equity market volatility compresses, the institutional securities revenue line could give back a material portion of Q1 gains in Q2 or Q3.
Second is the NNA trajectory in wealth management. $118 billion is extraordinary. The question for the next 2 quarters is whether that reflected unique Q1 conditions, tax season asset movements, delayed year-end reallocations, or a structural acceleration in client acquisition that the firm can sustain at $50 to $75 billion per quarter.
Third is the regulatory environment. CET1 at 15.1% looks comfortable, but Basel III Endgame finalization and potential stress capital buffer increases remain live risks. Any forced capital build reduces the pace of the $20 billion buyback program and directly compresses the ROTC trajectory that currently supports the premium valuation.
And macro dislocation is always worth watching for a firm this globally exposed. Morgan Stanley operates in over 40 countries. Trade policy uncertainty, currency moves, and geopolitical stress can simultaneously freeze the deal pipeline and reduce client risk appetites in wealth management. Morgan Stanley just delivered one of the best single quarters in its modern history. Net revenues of $20.6 billion, up 16%, EPS of $3.43, 12% above consensus, ROTCE of 27%, record revenues in all 3 segments simultaneously, wealth management hitting its 30% pre-tax margin target ahead of schedule, and $118 billion in net new assets in a single quarter.
The financial profile supports the story. CET1 at 15%, equity of $112 billion, a new $20 billion buyback authorization, and a 2% dividend yield. The firm is returning capital aggressively while simultaneously growing its client asset base.
The key watch from here is whether the wealth management NNA trajectory and the 30% margin are durable, or whether Q1 reflected seasonal and market conditions that won't repeat at the same level. That answer comes in Q2.
The metric to track is wealth management net new assets. Above $75 billion in Q2 confirms the flywheel acceleration thesis and sustains the premium multiple. Below $50 billion with margin compression signals that the Q1 print was partially a one-quarter event, and the stock likely gives back some of its post-earnings gain.
We close every episode with a quote that fits the company. Warren Buffett once said, "The best investment you can make is in yourself." For Morgan Stanley in 2026, that line lands differently than it sounds. James Gorman spent 14 years investing in Morgan Stanley itself, transforming the business model, building the wealth management infrastructure, acquiring E-Trade. Ted Pick is now harvesting those investments. The 27% ROTC in Q1 is the return on years of strategic capital deployed in changing what Morgan Stanley fundamentally is.
It's a reminder that the best businesses aren't built in quarters. They're built over decades of deliberate reinvestment in competitive advantages. Morgan Stanley's Q1 2026 is a moment that justifies 14 years of patience.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.